Yes, please go ahead.
Yeah, thanks, Shilpa. Just a second. So it's my privilege to introduce the speaker of our day, Mr. Uttam Padival. He is a chartered accountant, a fellow member of ICAI, and he secured a rank in bachelor's degree in commerce from University of Mysuru. He is also an IBBI registered valuer in respect of securities and financial assets from ICAI RBO. He also holds diploma in international taxation awarded by ICAI. He has held various positions in the managing committee and is currently the chairman of ICAI Mysuru branch SIRC. His corporate experience includes working as business analyst in a global business and technology consultancy company. As part of his employment, he has participated in overseas development and implementation of software projects. He is currently practicing under the banner of Padival and Associates, a consulting firm providing services in the field of accounting, finance, taxation, valuation, transaction advisory, assurance, and regulatory compliance support. On behalf of Bangalore Valuers Association, I welcome you, Mr. CA Uttam Padival. You're most welcome, and on to you. You can take the session now.
Thank you, Sheetalji. Thanks BVA for providing this opportunity to share some of the experiences relating to income tax and valuation. I see that BVA has come a long way. I remember somewhere in 2020, somewhere in the month of July, when we moved on from the physical weekly meetings, bi-weekly meetings to online meetings, and it's come a long way. It's come a long way. Congratulate BVA for that, and I hope to see a lot more from BVA. To start off the topic, what we have today is basically the litigations under the Income Tax Act relating to valuations. Before we actually start off with the litigation aspects of valuations under the Income Tax Act, wanted to highlight the importance of analyzing the purpose for which we do the valuation. So quoting from para 20.3 of International Valuation Standards Scope of Work, which basically defines the purpose of valuation, whereby it has been told that the purpose for which the valuation assignment is being prepared must be clearly identified, as it is important that valuation advice is not used out of context or for purpose for which it is not intended. The purpose of the valuation will also typically influence or determine the basis of value to be used. This is particularly important because we often get calls from our clients or prospective clients asking us quotes for valuations. So now, without knowing the purpose for which the valuation is being done, it would be very difficult for us to determine the scope for our work. So I mean, it baffles me. It baffles me when people basically typically bypass the purpose for which discussion on purpose for which the valuation is done, and they just want to get a number in mind. So what I want to drive home the point is that the purpose of valuation is very, very important for us before we get into the actual nitty-gritties of valuations. And just one second, just one second. Yes, yes. Thank you. Thanks a lot. Thanks a lot. So, with regards to income tax, also we need to clearly understand the purposes of valuation. So, in this context, now, although under the Income Tax Act there are various provisions which require valuations, I mean, for instance, there is valuation requirement. There is requirement for valuation when there is a ESOP allotment. especially from the perspective of the employees, to determine what would be the value of perquisites, and if there is any change in the in the partnership interest, then also valuation will be required. If there is a change in the, if there is a slum sale, valuation requirements kick in. So there are a host of provisions which require valuations to be done. So in this discussion, in today's discussion, since we are valuers of shares and securities, let me limit the discussion to valuation of shares and securities which result either from transfer of shares or from allotment of shares. As you all know, there are two typical transactions which happen with regards to shares. One is either allotment of shares, which is in other words known as a primary transaction, or once the allotted shares are transferred amongst the various shareholders or new shareholders, which is known as a secondary transaction. So we will limit our discussion to these two aspects of shares and securities, emanating from either transfer of shares or from allotment of shares. Now, when there is a transfer of shares, we all know that there are three parties which will be involved. One would be the transferor, one would be the transferee, and the other one would be the issuer company. When it comes to allotment of shares, there are only two parties involved. One would be the issuer company and the other would be the shareholder. In this case, the shareholder is nothing but the recipient of shares. Now, there are various income tax provisions which require valuations. So if we have to appreciate the purpose for which valuation is done, then we need to understand the provisions which determine the valuation. We often get calls, we often get inquiries as to whether when there is a transfer of shares, would there be a requirement for valuation? If there is a requirement for valuation, how should the valuation be done? So there are various queries which we will have to address. If we have to address these queries, then we need to know the purpose for which these provisions have been made. So we have tried to split the entire valuations into valuation requirements relating to shares and securities into various parts. And this particular slide depicts the income tax provisions on the transferor in the case of transfer of shares. So basically, when there is a transfer of share from one person to the other person, what would be the tax implication on the transferor is highlighted in this particular slide. The reason why we want to highlight this particular provision is because the purpose of valuation, the method of valuation, all would be determined by this particular provision. So just to run through the, just quickly run through the income tax provision before we get into the valuation nitty-gritties. So when there is a transfer of shares, that is one person transfers the shares to another person, then there would be tax implication on the transferor. As you all know, if there is a transfer of shares and if these shares are held as an investment, then the difference between the selling price and the purchase price would be taxed as capital gains in the hands of the transferor. We'll not get into the nitty-gritties of that. If the shares are held as a stock in trade, then the surplus, that is basically the difference between the selling price and the purchase price, would be taxed as profits and gains from business or profession. So we will not be getting into these two provisions. In addition to these two, so for computing the normal capital gains or for computing the more normal business profits, there is no requirement for valuation. However, there's one particular specific provision which requires valuation, and that particular specific provision which will be applicable to the transferor on transfer of shares is Section 50 CA. Please note that this particular provision is over and above the capital gains provisions and the profits and gains from business or professional provisions. This is an anti-abuse provision. This is an anti-abuse provision, and let's spend 1 minute to understand why this anti-abuse provision has been implemented. Typically, what was found is when a person transfers the shares to another person, then the actual sale consideration might not be recorded in the books at the actual prices. So we might all have experienced this with respect to immovable property. Typically, what happens is there's something called as a stamp duty guidance value, and there is also the transaction value. So what also happens in certain cases is that although the actual sale or purchase happens at a higher price, a price higher than the guidance value, still people will basically do the documentation on the stamp duty value, and the difference is what they will be managing through cash. So in order to avoid these kind of cash transaction, avoid transactions being recorded at prices lower than the price at which they are actually sold, in case of immovable property, there is this provision 50C. Similar to immovable properties, in case of shares and securities, there is this provision called 50CA, which is basically an anti-abuse provision, which says that if the shares are sold at a price below the threshold value, then the difference between the selling price and the threshold value, between the fair market, between the selling price and threshold between the threshold value and the selling price, will be taxed in the hands of the transferor over and above the capital gains. I'll just repeat it. If a particular transaction is done at a price below the threshold value, then the difference between the threshold value and the transaction value will be taxed in the hands of the transferor. So this particular provision is not in the hands of the transferor. This particular transaction covers both quoted as well as unquoted shares. So in the case of quoted shares, if the transaction is consummated at a price if the transaction is consummated at the stock exchange, in a recognized stock exchange, then there is no requirement for any valuation. However, if the transaction is consummated, if a quoted share is consummated in a transaction other than through recognized stock exchange, then the price at which the shares were quoted on the date of the transaction will be the price which will be considered as the threshold value. If on the date of the transaction the shares were not transacted in any recognized stock exchange, then the price prevailing on a date which was closest to the date of the transaction will be considered to be the threshold value. Now, if there are multiple threshold values, then the lowest of the threshold values will be considered. This is the provision with respect to quoted shares. With respect to unquoted shares, what is required to be computed is the minimum threshold value. And if the unquoted shares or securities are equity shares, then the minimum threshold value will be computed with reference to the adjusted book value. We will come to the definition of what adjusted book value is. And if the shares or securities are not equity shares, then it would be the open book value. So what we need to keep in mind is that we are looking at the minimum threshold value. If the actual transaction is consummated at above the threshold value, then there will not be any additional tax implication. However, if the actual transaction is consummated below the threshold value, only then the additional taxation provisions will kick in. So what we need as valuers, what we need to identify is the minimum threshold value. Now we should all appreciate that for this particular provision, can we adopt any valuation methodology? The answer is in negative. We cannot adopt any valuation methodology for this particular purpose. The purpose being, when there is a transfer of shares and we are determining any additional tax implication on the transferor, then the only method which is applicable for us to determine would be the adjusted book value method. In the case of quoted shares and securities, it would be the actual market. It would be the market approach, and it would be the actual transaction value method. Whereas in the case of unquoted shares, for equity shares, it would be the adjusted book value, and for unquoted shares or securities other than equities, it would be the open market value method. Open market value method can either be computed either in the form of in the way of comparable transaction multiple method or comparable market multiple method, or if these comparables are not available, then we can also use the DCF method. Please note that these methods are available for shares other than equity shares. As far as equity shares are concerned, it is only the adjusted book value method which is prescribed for computing the additional tax liability on transfer on in the case of transfer of shares. I'll give a minute to basically go through this particular slide, and if there are any doubts here, I'll address that. If there are no doubts, then we will go to the tax implication on the transferee.
Good morning. Sir, good morning.
Yes, sir.
Hello.
Good morning, Chandrasekhar sir.
Yeah. Sir, in case of in case of unquoted equity shares, say
Sir.
preference shares, debt instruments.
Okay.
What is the basis? You said the comparable market price. Those things will not be available. No? Assuming that unquoted, there is a private limited company. They're selling there is a transaction of transfer preference shares.
Okay.
So how do we value? Is it do we have to do this like taking the risk rate, something like that? How do we the preference shares? We have to,
Definitely. I mean, I would not agree with you, sir, when we say that the comparable market multiples will not be applicable. There will, in case of unquoted shares, there is definitely a challenge to establish the comparability. If we are able to establish the comparability, then we can definitely use the market approach and any of the methods prescribed under the market approach. While establishing the comparability, we need to look into the various aspects of comparability. And if you are able to establish the comparability, then I don't see a reason why we cannot use the market approach.
okay. If you are unable to establish,
Okay, if we are unable to establish, then I mean the regular way in which we do the in which we select the approach is basically, if the comparables are available, then we use the comparable we use the market approach. If the comparables are not available, then we fall back to the income approach or the cost approach. If we are able to predict the future with reasonable certainty, with reasonableness, then we can adopt the income approach and discounted cash flow method. If we cannot predict the future cash flows with reasonable certainty, then we do not have any other option but to fall back to the cost approach. Now, cost approach might, in my suggestion, cost approach would be the least preferred approach. Before selecting the cost approach, we'll run through market approach and the income approach. Only if these two approaches are not suitable in that particular situation, will we fall back to the cost approach. Does it answer your question, Chandrasekhar?
the question is understood, but I got it. But only the problem is, assume that preference shares,
Yes.
bought back, the company they showed 5 years before. Now they're selling, and normally when the preference shares sell, then normally almost they'll get slightly more than the its nominal value. So in that case, whether really minority valuation report is required. If it equity shares and there is a worth, preferred debt instruments, only the coupon rate is the income.
Correct.
Yeah. In that case, where is the income really? I don't see. If they sell, whether is it justifiable saying that this is there's no significant. Suppose if you go again, if you do the indexation, cost will be more than the selling price.
Okay.
So what is the practical approach? Whether really is there any logic for this valuation report?
Sir, now when we are talking about a limited purpose for determining the additional tax implication on the transferor in the case of transfer of shares. So are we clear about that? I mean, is that the case in which we are dealing with? If
Yes,
that's
yes,
the case,
correct,
if that's
correct.
the case, what we have to determine is the minimum threshold value, sir. If the, I mean, let's presume that by using whatever method we arrive at a particular valuation, and if the actual transaction value is above this particular threshold value, then there is no problem.
Okay.
So it is the minimum threshold which we are looking at. So basically, when we are determining the tax implication on the transferor, we should determine the minimum threshold value. In such a case, I mean, one of the practical approaches which we can use is, if there are no comparables available, if there is if we are not in a position to use the income approach, then let us fall back to the cost approach.
Okay.
As you know that the cost approach yields, especially the book value method in the cost approach, yields the minimum value. Now, if we are able to establish the fact that no other approaches are available, no other methods can be used, and because of the limitation of inability to use any of the methods, if we are using the book value method, and by using the book value method we arrive at a value, and if the transaction is consummated at above the book value method, then I don't see a reason why that valuation cannot be accepted.
Okay.
Here the biggest challenge is not the value, but the biggest challenge would be to establish the fact that there are no other methods of valuation can be used in that particular case.
Sure. Thank you.
So nice of you. Okay, so now this here, please note the importance of the word adjusted book value method. Now, what we are trying to address here is, if we have been asked to determine the additional tax implication on the transferor in the case of transfer of shares, and these shares which we are talking about are unquoted equity shares, then the only method which is applicable would be the adjusted book value method. Now, we all understand what is the book value method. Book value method is assets minus liability, the book value of assets minus liabilities. The words used is adjusted book value method. In the case of adjusted book value method, it's a combination of the market approach. In valuation terminology, it's a combination of the market approach and the book value approach. The reason why I say it's a combination is because for certain asset classes, we ignore the book value but replace it with the market value. For certain asset classes, we consider only the book value. For instance, in the case of immovable property, we ignore the book value and replace it with the stamp duty guidance value. For other asset classes, we consider the book value alone. Let's take an example. Let's presume that there is an immovable property whose book value is 100 rupees, whereas its market value is 1000 rupees and stamp duty value is 600 rupees. So in which case, for computing for this particular purpose, we do not consider the book value of 100 rupees. We do not consider the market value of 1000 rupees. We consider the stamp duty value of 600 rupees. That is specified here. Even if the market value is, even if there are positive indications that the market value is higher than guidance value, we do not consider that market value, but we consider only the guidance value. Let us take one more example. Let's presume that in the books of accounts, the debts are recorded, the book value of debts of trade receivables is, let's say, 800 rupees. But we know that these debts are not recoverable. However, although we know that the debts are not recoverable, however, on the date of the transfer of shares, as per the balance sheet, there is no write-off of these books. In which case, we cannot consider the subsequent events and take the written off value of debts, but we have to take only the book value of debts as on the date of the valuation. So here we do not have the liberty to change the values in accordance to the other rules of valuation. We will have to apply the same value as the same value as has been prescribed. We do not have the liberty to change the values. So this is what is meant by adjusted book value. The what value should be taken, what value have to be adopted for what asset classes, what value should be ignored for what liability classes have been defined in rule UA sub rule 1. So only that rule A sub rule 1 valuation method should be adopted. We do not have the liberty to change the valuation to any other methods. Now moving to the
Mr. Uttam,
Sir.
one doubt here.
yes sir.
In the unquoted equity shares and unquoted shares other than securities,
Yes sir.
unquoted equity shares value in net adjusted value can be given by any person, RV, CA, CS, or when management can obtain. Only for other than equity, it requires a CA minimum merchant banker.
CA
Need
or
man-
the merchant banker. Yes.
Okay, for other one, any person, no, need not be RV or need not be CA. Any professional, as long as he can establish the independent, the NAV.
Definitely, Chandrasekhar sir. In fact, I'll go one step forward to say that there is no need for any valuation report at all.
Exactly, it is only a summation.
It is just a valuation memo. If I am approached as a valuer to give the valuation report, I would detest myself for giving a report. I will not give a valuation report for this purpose. Rather, I would call it as a valuation memo. It's just an advisor. It's just a computation. No other aspects of valuation need to be followed here with respect to this particular case when we are doing the valuation of equity share for the purpose of transfer.
Okay, thank you.
Now, when there is a transfer of shares, and if this particular transfer now if there is a transfer of shares, and if the transfer of shares, and we will have to determine the tax impact on the transferee, which is the recipient of shares, then also whatever valuation requirements are applicable to the transferor, the same valuation requirements will also apply for the transferee or the recipient. And the same thing which we have discussed for the transferor will also be applicable to the transferee. No changes. Verbatim, whatever is applicable to the transferor will also be applicable to the transferee or the recipient of shares. So, I mean, since we have discussed in detail as to the tax implication on the transferor, I think we can skip the tax implication and the valuation requirement for the transferee or the recipient. Unless anyone has a question, I'll just pause for half a minute to check if anyone has a question on the tax implication on the recipient in the case of transfer of shares.
Yeah, can you actually explain Uttam on that as well, on the transfer? Because on the transfer, you said that this is an anti-abuse law, and if you try to do a sale below the threshold value, there is going to be a penalization. There's going to be tax between the difference between the threshold value and the value actually at which the transaction is consumed. So to that extent, when I revert it to the transferee who is actually receiving at a particular value, so it would be threshold value, above the threshold value or below the threshold value. How would it look at this particular transaction? And second thing is, I'm assuming this report of this particular thing can be done by any one person, either the transferor or the transferee, which is good enough from an income tax perspective. Both need not do the same thing.
Definitely. Thanks, Ganesh. I mean, I'll address these two questions. The first question was, what would be the tax implication on the recipient or the transferee? So the purpose, again, this is also an anti-abuse provision. So now, if we have abused the provisions, then provisions with respect to transfer of shares and securities, then there will not be single taxation. There will not be double taxation. There will be triple taxation. So basically, one is on the basic transaction, which is as per the capital gains, which will be applicable on the transferor alone. In addition to this transferor, if we have artificially depress the price of the transaction. In other words, if actually the transaction was consummated at 100 rupees, but artificially I have shown it as 60 rupees, and the remaining 40 rupees I have appropriated through through other channels, then, and if it is proved that I have done this kind of tax avoidance mechanism, then the anti-abuse provisions will kick in. What would happen is, in the case of transferor, although the transaction is shown to be consummated at 60 rupees, for the transferor, 60 rupees will be ignored and 100 rupees is what will be considered. And in addition to this, in the case of the recipient, normally when I purchase the shares, there should purchase any asset, there will not be any tax implication. But this is an anti-abuse provision, and if it is proved by the income tax department that I purchased the price at below the threshold value, difference between the threshold value and my actual purchase price will be taxed in the hands of the recipient as income from other sources, and it will be taxed at the rates at which the recipient normally pays the taxes. If he's paying the tax at 30%, then he will pay 30% on the difference between the minimum threshold price and the price at which he has actually purchased the shares. So this particular provision has been made to prevent people from artificially depressing the price of transfer of shares. Is that clear, Ganesh sir? Shall I move to the next part?
Yeah, understood.
Cool. Now the next part is, can this valuation be done by any person? The answer is an affirmative. Actually, there is no requirement for any valuation report except for transfer of shares other than equity shares, transfer of unquoted shares other than equity shares. For every other purposes, it is just a valuation summation valuation exercise which has to be carried out and which can be carried out by any particular party. Does it answer the second part of the question, Ganesh sir?
That I understood actually. So essentially we are able to clear that totally in effect there will be three taxes. One is the regular capital gain, one is the below threshold. So transferor will face two kinds of taxes. Transferee will take off one tax if it is below the threshold value. If it is above the threshold value, it doesn't matter for transferee actually. And the cost of acquisition for transferee would be the threshold value even if he buys below the threshold value, because he is going to buy the income tax. The cost of acquisition in their books will be a transfer. Okay, thank you.
Definitely, sir. Thankfully, this particular provision has been amended. Had this particular provision not been there, then there would have been four taxation. So, I mean, what we need to understand is that it is the minimum threshold value which we have to compute. A lot of people get confused here. The reason why they get confused here is because the terminology used in the Income Tax Act, which does not use the word minimum threshold value, but it uses the word fair market value. And this fair market value has been defined in 11 UA to mean that it is the minimum threshold value. So in the case of transfer of shares, if you are approached by any particular party to compute either the transferor or the transferee, then it is the minimum threshold value which we will have to compute. Now, to answer your other question, Ganesh sir, as to whether there needs to be two valuation computations, one for the transferor and one for the transferee, or a single valuation exercise is sufficient, the answer is it's a professional opportunity, Ganesh sir. Now, if the transferor approaches you and asks you to do this particular computation, then you can give a report addressed specifically to the transferor. If the transferee comes to you again, then you can basically give one more report addressed to the transferee, and you can basically look it as a professional opportunity. If both of them come to you jointly, then you can give a single report addressed to both the transferor and the transferee, because probably the chargeability of the fees might be different when both the transferor and transferee approach you collectively. It's purely a professional decision to take. As far as the law is concerned, the law is silent about this, because the law says there is no requirement for the valuation report itself. When law is so silent, then whether the valuation report is addressed to the transferor or transferee is immaterial. Fine. Anything else, Ganesh sir?
Thank you so much. If members agree, one tricky part, if I would like to introduce how one could abuse 11UA so that we can get your insights. Can I ask that question?
Please.
It's a tricky part. Yeah. See, what happens? I'm giving a real case so that all of us can look at it. There are totally 3 shareholders in a company. Okay. So what happened is two shareholders and one company is there. So what company did is he had issued shares at par value to one shareholder, and that shareholder had been issued huge number of shares. That par value is incorrect value. Let me put it very clearly. That par value is the incorrect value in terms of the valuation. How he did it, what he did, we don't know. There's a memo that he got it. And therefore, what would have been a 11UA value before this particular incorrect merger or amalgamation issuance, whatever has been taken care, the value per share under 11UA was, say, very high, say 2,000 rupees. Okay. Because of this issuance of shares, the share capital has increased and it was issued incorrectly at, say, par at 10 rupees. Effectively, now the value per share under 11UA became 500 now. The 2,000 has become 500 because the new issuance of shares have come up. Now, this particular company is getting valued again because there is genuinely a third shareholder is there. Now, when he wants to do it, he's a transferor now. He asked to conduct a 11UA. The 11UA gives only 500 now because of the previous incorrect action of the thing. That's what the books as of today. The concern is if he does it at 500, which is as per the books today, the previous transaction was accepted and under the court of law NCLT that disclosures all have happened. Whether today he would be liable if income tax, when later couple of years starts digging the transaction and says that this 500 is I'm talking about the third shareholder who's a genuine guy. Any impact to that guy? Because you said 11UA is the basis. The 11UA got abused here.
Okay, fair enough. So now here what we need to appreciate is that the reason why 500 might not be the 500 rupees per share is not probably the right value is the reason why this got triggered was because of the previous transaction, which was allotment of shares to the existing shareholders at a less than fair market value.
Correct.
So now what we are addressing here is the spillover effect of the previous transaction.
Correct.
We will address that spillover. What would be the impact of allotment of shares? We'll address it. We will be addressing it. We'll address it when we are referring to valuation requirement on allotment applicable to shareholder. We'll address that, sir.
It is not a shareholder, it's a third party, not a shareholder actually.
No, I mean, third party will become a shareholder. I mean, I don't mean an existing shareholder. It would be a shareholder, be it existing or a new shareholder. We'll address this particular issue.
We'll wait. Thank you.
Sir, Ganesh, just to address one point here, as Mr. Uttam said, this is applicable, and now we're discussing about only transfer, not issue. Second thing is, in case of a transfer of shares through NCLT, this is not applicable. So this is only between a buyer and seller, which is an not NCLT transaction. But again, your question is the anti-abuse. It comes under 11, the issue of shares, sir.
Yeah, only, sir, what happened, I mean, I'm trying to digress, sorry, we'll park it for sure.
Sure.
What happens is, if the book value per share has been abused by issuing certain shares at par value and reducing per share value of the company, okay, the previous transaction is incorrect, it is abused. As a genuine transaction today, as per my books of accounts, do I have any impact? That's all I'm asking the question. And I can explain to you when it comes later, certainly. Because it's a live case.
We'll address that, sir. We'll address that, sir. Just one second.
You.
Just one second. 9:30 phone. So, now, I mean, the other part which Chandrasekhar sir mentioned was in case of NCLT, this particular provision will not be applied. So, companies can go ahead and basically transfer the shares at below the book value. It's a good point. Chandrasekhar sir, I want to highlight one point here. Now, let's presume for whatever reason the transaction got consummated below at a particular price at the NCLT level. do you think, I mean, from your experience, this got nothing to do with valuation as a general question. Do you think there would be any cases where a transaction would be consummated at below the book value, even under the NCLT?
I will not say book. Normally it is more, but even if it is below, what I am saying is under section 47, transfer shares allotted in the scheme of amalgamation is not a transfer. So their question of checking, just assuming that I'm whatever shareholders getting shareholders of a transfer company as consideration, cost of acquisition will be adjusted based on their previous cost. This transaction they have simply ignore when they get the shares of a transfer of transferring company. When they sale consideration minus cost of acquisition of initial shares will be treated as the cost of acquisition with the proper adjustments. So this transaction is totally exempted. It is not transfer at all.
Fair enough,
So
sir.
there is a question of pay above and below fair market value.
Fair enough, sir. Fair enough, sir.
Yeah.
Fair enough, sir. Good point. So, I mean, now we'll look into the third party when it comes to a transfer of shares. When it comes to a transfer of shares, there will be a transferor, there will be a transferee, there is also an issuer company. As you all would know that, as you all would appreciate that when there is a transfer, then there is a secondary transaction between where one shareholder is replaced by the other shareholder. The issuer company is as is not impacted in any way, and accordingly there is no tax implication, and accordingly there is no valuation requirement on the issuer company. So an issuer company has no role to play. An issuer company has no role to play when it comes to a secondary transaction, that is transfer of shares. Having said that, we said that we will have to do the valuation for the transferor and transferee either on the basis of book value method. In the case of unquoted shares, we will have to do either in the case of using the adjusted book value method or the open market value method. Now, if the issuer company does not cooperate, will we be able to compute these values? The answer is in negative. So, as a practical approach, we always need to keep the issuer company in mind while doing any computation, because we will be relying on the issuer company for information requirements. So now, if we are approached by any person asking us to do a valuation computation or a valuation report for transfer of shares either from the recipient or the transferor, what we need to compute is when we get the engagement letter done, we need to basically get a representation from our client, which can be either the transferor or the transferee or can be both. We need to take a representation from him that they will take the responsibility for providing the information from the company. If we have this particular clause in our engagement letter, then it will save us a lot of time and energy if this particular valuation which we do is litigated in the future. Otherwise, we might be asked a question as to what is the basis for us to derive these values. So in order to preempt that, I would suggest in our engagement letters for this particular purpose, let us have a representation where our client, which can be either the transferor or the transferee or can be both, will give a representation to us that they take the responsibility for collecting the information from the issuer company, and we that will save us a lot of time and energy for collating the information. Moving forward, before we proceed to allotment of shares, till now we have discussed the secondary transaction, which is transfer of shares or securities which have already been allotted. We will next discuss on the tax implication on transfer on allotment of shares. So before we get into this, because these are two different provisions, we should not get confused. Until now, we were only dealing with minimum threshold value. From now, we'll be dealing with fair market value. So let us basically reorient ourselves for the next discussion. In order to help us reorient ourselves to the next question, a small question which I want to pose before you, respected audience. Let us basically look into this particular transaction, the one which is available on the screen. So there is one Mr. X who purchases books for 100 rupees. He sells the book for 120 rupees. So, can we know as to what is was X income at this point of time? What will be considered as X income at this point of time?
20.
Yes,
20
pretty right. Pretty right. Now we move one step forward. Now, Mr. X buys back the same book which he had earlier sold at 120 rupees for 130 rupees. Now, what is X income? X consolidated income. Is it 20 rupees? Is it 20 minus 10? 20 minus 10, 10 rupees? Sorry?
Same 20 rupees, sir.
Same 20 rupees. Any other answers?
No, when he bought back, when the question of this, see, he bought 100 rupees, sold it at 120, 20 rupees is income. The transaction is over. Again, he is buying the same book for 130 rupees. He is selling at 160. So in the next transaction, 160 minus 130. We have to go.
No,
transaction
we'll not go to the
transaction.
next. We'll only stop at this. We'll go to the next question when we reach there.
Okay, you are saying that he bought, sold at 120, again he bought at 130.
Correct, sir.
But according to only 20
Where,
rupees.
where is the question of income? It's a cost of acquisition. Eh?
Correct, sir. Now, the
There's no
consolidated income. He had earlier made a profit. We'll carry forward that profit of 20 rupees. Now he has purchased. Will the consolidated profit, accumulated profit of 20 rupees get impacted because he has bought it back at 130 rupees?
No, because transaction. Now,
Perfectly right, sir.
I'll sell and buy. Each transaction we are treated separately.
Let's move it forward. You're perfectly right, Chandrasekhar, sir. Let's move one step forward. Now, the book which he has bought back for 130 rupees, he has sold at 160 rupees. What is X consolidated income?
30 plus 20, 50.
Perfect, sir. Perfect, sir. So I'm pretty sure that all of you in this particular forum agree that the consolidated income of X is 50 rupees. Now, you might feel as to why have I posed this particular question. The answer is very simple. When we go out of this forum, when we go to the real world, a lot of people get confused with the third bullet point, which is what would be the impact when a person purchases a particular asset at a higher value, at a value higher than its actual prevailing price. A lot of people in the real world will basically say that if a person has purchased a particular asset at higher than the prevailing price, then he incurs a loss. I am so happy that in this particular forum, we all agree that when a person purchases any particular asset, then he does not make any profit or loss. It is only when there is a sale which happens that a profit or loss will kick in. When a purchase happens, profit or loss does not kick in. Having said that, in the field of income tax, when we purchase any particular asset, even then the taxation impact, there will be a taxation impact, and these are anti-abuse provisions. These should be viewed with a limited purpose, that these are used only for testing abuse of any provisions. So we all needs to be in this particular forum. We all are rest assured that when there is a purchase of any asset, there will not be any tax implication. That is genuinely the case, which will be applicable for most of the cases. But when it comes to anti-abuse provision, this general understanding will not hold good. We still need to, there will be tax implication when we purchase a particular asset, and that tax implication should be viewed from a limited perspective of anti-abuse. This was just to basically separate the discussion which we had now, because we all have a hangover till now that it is the minimum threshold value which has to be computed. But now the concept will change when we are looking into the next part, which will be the tax implication on allotment of shares. The transaction which we are talking about is, yes, sir.
In the same your case, as you said, this previous case,
Yes, sir.
Purchase price will be considered as an differently.
Correct.
That is only in case if there is any avoidance of tax. If I assume that I sold at a lesser price, bought more price, then only they can test. Otherwise, not in general situation, no.
Not in general situations, sir.
Because it can happen, I'll sell my property today. Afterwards, I wanted to buy it. It can be real genuine transaction. It can be what you call a planned transaction also. So this is only for testing purpose.
Definitely, sir. Sir, when it comes to immovable property, as long as I have done the sale or purchase at above the stamp duty
That is
value,
value.
there is no impact. Similar provisions applicable to shares and securities also. As long as I have sold or purchased the shares or securities at above the minimum threshold value, the minimum threshold value will be computed using any of these last green colored last four boxes. If these are computed in using any of these methods, applicable methods, and if the actual purchase or sale price is above that, then there is no question of any the transaction value being questioned, sir.
Oh, oh. Right.
So now, when it comes to allotment of shares, let's forget the minimum threshold value. That is not what we are testing. We are actually looking at the actual actual tax impact on the issuer company. So the provisions of the Income Tax Act which determines this particular taxability is section 56(2)(7)(b), read with rule 11(ui) of the income tax rules. This 56(2)(7)(b) has gained the popularity of as angel tax, but let me assure you, there is no sense of angelity with respect to angel taxes. In order to appreciate that, we need to go one step back to understand what is this, why this particular provision has been implemented. So typically, what is the kind of transaction which we are looking at? When a company allots shares at premiums. When company allots shares at premiums, then this particular provision will kick in. So one of the important things is there has to be allotment of shares at a premium. If allotment of shares happens at par or below the face value, then this provision has no applicability whatsoever. So one of the important condition is there has to be allotment of shares at a premium. So now this is what we have tried to capture here. On the left hand side, the first box in the left hand side says if the allotment at or above below the face value, then this provision is not applicable. This provision is applicable only when there is allotment of shares at above the face value. Now, if
Uttam, just to add that, it is not permitted unless it is so, because Companies Act doesn't permit allotment of shares at a discount.
It is Companies Act, sir. We are not getting into Companies Act. We are not getting into whether it's allowable or not available.
Agree. What I'm saying is when a company issues shares only, this will come. First of all, at a first level itself, company is prohibited in issuing the shares. So unless it is an ESOP. So this question, though it is a tax impact not applicable, but in general, company cannot issue. That's what I wanted to just update.
Fair enough, sir. Fair enough, sir. Fair enough, sir. So that's a company law matter, and you guys are company law experts. So basically, I'll take your word for that, sir. Now, when it comes to allotment of shares, if the allotment of shares is by listed company, again, this provision is not applicable. So if an listed company allots shares at a premium, then this provision is not applicable. It is applicable only in the case of unlisted companies. Again, in the case of unlisted companies, there are certain companies to which this particular provision is not applicable. That what we call it as is exempted companies. Please note that the terminology exempted companies is not used in the Income Tax Act. Only for the limited purpose of this particular slide, we have used the words exempted companies. It does not find definition in the Income Tax Act. Because we had limitation of space, we use the word exempted companies. Now, what are these exempted companies which are not covered under the section 56(2)(7)(b)? These can be venture capital funds, provided the venture capital funds have raised capital from approved venture capital funds. One more category of exempted companies are startup companies which have got registration from DIPP, those are also not covered. In addition to that, if there is a company which has gone through NCLT and the allotment of shares is under the NCLT order, that is also one category of exempted companies. So these are the kind of exempted companies which, even if they allot shares at a premium, this section 5627B will not be applicable. Now, whatever companies are left out, apart from these exempted companies, apart from listed companies, if there are any companies which are left out, only then section 5627B or angel taxation will be applicable. With respect to such companies, the allotment might be of equity shares, of allotment of CCPS, or allotment of other shares and securities. Now, if a non-exempted private company, unlisted company allots shares and securities other than CCPS or equity shares, then this provision is not applicable. In other words, if a private limited company, which is not a startup or which is not exempted under other categories, if it allots, let's say, a CCD, let's say it allots a CCD or a OCPS at a premium, then this particular provision is not applicable. Any doubts here? Cool. So,
If the company are not
carry on, sir. Yes, Chandrasekhar, sir. Sorry, we lost Chandrasekhar, sir, there. But once he basically joins in, probably will address the question. As of now, CCPS, this angel taxation 5627B will be applicable for allotment of shares at a premium by a unlisted non-exempted companies, and when the allotment is that of either equity shares or of CCPs.
okay, thank you.
Yeah. Now, again, when it comes to allotment of equity shares, the allotment might be to residents, it can be to non-residents. We are referring to the two boxes which are available on the left bottom. So now here, if allotment of shares is to resident shareholders, then the method of valuation applicable would be either the book value. Please note, the words which we have used are book value and not the adjusted book value which we had used in the previous slide. It is the book value, or the value as per the merchant banker report using DCF method, or if the company is a venture capital company and it has allotted the shares to non-venture capital companies, then also this particular provision is applicable. But in this case, if the price is the same as that of the allotment done to venture capital company to another venture capital company on or before 90 days from the date of allotment to non-venture capital companies, then we can adopt the same price at which shares were allotted to the venture capital companies. And if the allotment is done to notified entities, then the price at which shares were allotted to notified entities, the same price can be adopted, provided the consideration was received from the allotted from the notified companies within 90 days. This is the first provision. I'll just basically the leftmost. I'll just pause for few seconds for this to sink in, and then we'll look into the other parts. Any questions? I'm happy to address here.
Again, this book value, earlier we are the rule 11 we were using net adjusted value. Here also, is it the same, or this is not adjusted value?
No, it is not the adjusted book value, sir. It is just the book value method. For example, let's say there is a company which has immovable property on its books. The immovable property, the stamp duty value is the book value is 100 rupees, whereas the stamp duty value of this is 1000 rupees. Then for the purpose of the transferor, we will replace 100 rupees with 1000 rupees. But for the purpose of allotment of the allotting company, we will not consider 1000 rupees, but the actual book value of 100 rupees alone.
It's only stay plain book value, assets minus liability, net worth.
Plain book value, sir. Plain book value, assets minus liabilities. There is small adjustment which we will have to make with respect to tax assets and tax liabilities. I will not get into that. It's a very small thing. We'll not get into that. So the major thing which we need to keep in mind is, in the case of transferor, it is adjusted book value. In the case of the issuer company, it is actually the book value, pure book value.
But logic, I do not. Okay. I think.
Yes, it's very logical, sir. So basically, this particular provision is again an anti-abuse provision. In order to appreciate the logic, we need to appreciate the purpose for which this particular provision has been implemented. So what used to happen is, earlier, what used to happen is, a person would bring in a lot of unaccounted money into the company in the form of shares, in the form of share application money. So when a company accepts it, or the promoter of a company which accepts such money, he will accept the money and show it as share allotment price. But in order to avoid loss of control, he will show the allotment at a very high premium and allot a very small portion of shares to this scrupulous person, and that is how he will retain the control, at the same time receive the money. So in order to avoid this, we have got this 5627B in place, and in order to put the bar at such a low price, we have used the book value method. Otherwise, we would not have used the book value. That is the logics.
Okay. This second C and D, it means that if one French allotment is done under this category, next allotment within 90 days if happening, no valuation report required, same price can be used. That's what it means.
Yes, sir. And that value, I mean, it is at the option of the assessee, sir, of the issuer company. Let's presume shares were allotted. Let's presume shares were allotted to a notified entities at 120 rupees. Yeah. And within the 90 days, shares were allotted to a non-notified entity at 150 rupees. Then, if the company chooses to use the price at which shares were allotted to notified values, then the 150 minus 120 will 30 rupees will be taxable in the hands of the issuer company, which the issuer company would not want to do. So in order to avoid that taxation, it can get one more valuation done. Although it is within 90 days, one more valuation done and establish the fact that 150 rupees is the new fair market value.
Fair. Good. Thank you.
Cool. So now let me reiterate, if shares are allotted to residents by unlisted non-exempted companies at a premium, then the only plausible method, C and D are nothing but similar to transaction multiple method, and A is basically the book value method, which is nothing but the cost approach. B is the income approach. So technically speaking, income approach is applicable in this case and no other method is applicable. It is only the income approach which can be one of the plausible methods which are applicable. However, when shares are allotted to non-residents, the company will have other options which are available, which are comparable company multiple method, probably weighted expected return method, option pricing method, milestone analysis method, replacement cost methods. These methods are available at the disposal of the company when shares are allotted to non-residents, but when shares are allotted to residents, these methods cannot be used. Any doubts here? Cool. Now this covers the left bottom two blocks. Now we move to the
one question here.
Yes.
See, we all understand that if there is lot of intangible value is there, book value and value as per merchant banking report will be completely different.
Definitely, sir.
So this is again at the option of the issuer, any of the following.
Definitely, sir. Definitely. As the block starts with words at the option of the issuer. The issuer
Yes.
has complete flexibility to choose any of the methods within that block.
Yeah. So therefore, any company which has sizable intangible assets whose value is not captured in the book value comfortably can choose the method of book value to lower the price for the transaction if it requires.
Definitely, sir. But now, yes, if your question is, if a company which has sizable amount of intangible assets and therefore the value of the company is higher, but in order to abuse, it wants to allot the shares at face value, then the answer is in affirmative. It can go ahead and allot the shares at face value or at a price higher than the face value at the book value, but definitely below the fair market price.
In continuation with that, say in a real estate entity, there are a lot of transactions that happen where the book value does not reflect the market value of the real estate land banks.
That's
So but therefore the value using merchant banking, which captures the potential development capability, will be much higher than what is shown in the book value because book value captures the historical prices.
correct.
There also it can abuse.
Correct. So now yes, it can definitely do that. But in my humble opinion, the abuse will not be possible because there's something called as in the case of Kung Fu Panda, in the movie Kung Fu Panda, as Papa Joe tells Kung Fu Panda, there is something called as a secret ingredient. There is definitely a secret ingredient, Ganesh sir, and we'll discuss that secret ingredient if time permits. Because of this secret ingredient being present, there cannot be an abuse, is my humble opinion, sir. We'll address that. We'll address that.
Okay. I'll wait for that. Thank you, sir.
Yeah. So now, so basically, at this point of time, it would be good. It would be sufficient if you know that in the case of equity shares, comparable company multiple method, probability, option pricing, these methods are not applicable. Only in the case of allotment to non-residents are these options available. The issuer company cannot use these methods for allotment of equity shares at a premium to residents. Now, when it comes to CCPS, it is a bit more complicated. It is sufficient to say that a CCPS valuation can be done either by doing the valuation of CCPS on itself, or by doing the valuation of CCPS, or by doing the valuation of equity shares, and from that deriving the value of CCPS. So here, this is the only difference, and this is captured in the middle two, in the right side two boxes. I'll just pause a minute for this to sink in. So because it gives reference to other blocks, that's the reason it might sound a bit complicated. But the simplest rule is the allotment of shares to CCPS. When there is an allotment of CCPS by unlisted company, unexempted unlisted company, then the valuation has to be done either by doing the valuation of CCPS itself using any of the methods, or by doing the valuation of equity shares and then deriving the value of CCPS. So this is the general rule. Cool. So this is the provisions with regards to allotment, the tax implication on the issuer company when there is an allotment of shares. Now, when there is an allotment of shares, the tax implication on the shareholder will be similar to what it is in the case of recipient. However, whether there will be any tax implication on allotment of shares to the shareholder as a recipient is itself being questioned. It is still not, it has not reached the finality, but it is still being questioned. So it is sufficient to say that at this point of time, when there is an allotment of shares, there might be tax implication on the shareholder, on the recipient of shares, and this tax implication, it would be similar to that of recipient of shares, which we had discussed earlier. So at this point of time, Ganesh sir, you had questions as to whether there can be abuse. The answer is yes and no. There can be an abuse, but because of the existence of the secret ingredient, there will not be. We had basically addressed this particular situation. When there is an allotment of shares, would there be an impact? We had discussed this in detail, and we had written a particular piece in a CA journal. For the it's a very very detailed discussion which we'll have to say. And unfortunately, in the next 40 minutes, I don't think we'll be able to cover it. So for the A's, and to take it offline, since it's purely not a valuation discussion, but it is purely a tax discussion. In order to not abuse this particular forum, we can take this offline. Having said that, to give the benefit, we'll basically share the link to the article, which you can go through, and we can always discuss that offline. But at
Please
this
share the article.
At this stage, what we conclude is, irrespective of whether there is a secret ingredient or not, when there is an allotment of shares proportionate to the existing, when there is an allotment, not offer, when there is an allotment of shares at proportional to the existing shareholding, then the provisions of 56(2)(10) will not be applicable to the new shareholders or to the existing shareholders. That is the conclusion. If it is disproportionate, then there might be a tax implication. We'll share the article. I'm not sure, Ganesh sir, whether I have disappointed you, but that's purely a tax discussion which we can take offline.
Okay, I would not question that. Only thing is, the new person who wants to do the current transfer, whether he is safe, because the valuation report, if he is asking to give, you can only give as per what is the latest audited financials are. The previous abuse, because it is audited books, one cannot challenge. So to that extent, from a valuer, is he safe if he gives a report, and whether the transferor is safe, only to that extent.
Sir, to answer this particular question, I think the rules or the interpretation of the rules have not yet been so mature to deal with implication of taxes on the recipient of shares in the case of allotment. I'll tell you why. You mentioned the fact that there is this audited balance sheet which is applicable, which is one of the things, one of the valuation aspects which we will be discussing later. But let's advance that particular discussion to this stage at this time. So when we are using the book value method, we will rely on the balance sheet. When we are using the adjusted book value method, we will again be using the balance sheet. Now, there is one particular requirement which says balance sheet, the rules say it has to be audited balance sheet. And if the audited balance sheet is not available, then the latest audited balance sheet can be used, is what it says. Now, there was an interesting case which was discussed in this very forum a couple of days back, which was an interesting decision, and the decision is also interesting. The facts of the case go something like this. A company allotted shares on 31st March 2024, and on the date of allotment, the audited balance sheet was not available. So the previous audited balance sheet was 31st March 2023. Now the question was, if the allotment of shares happens at a price above the previous book value, then would there be any tax implication on any party whomsoever? So the department contended that since at the time of allotment, the only audited balance sheet available was the previous audited balance sheet and not the current balance sheet, we will have to go and rely on the previous balance sheet. The court, the tribunal held that the contention of the department is flawed. It said, although on the date of allotment, the audited balance sheet was not available, subsequently, the audited balance sheet was available, but there was a management represented audit report which was available, and this management represented audit report did not deviate much from the audited report which was available later. Therefore, this management represented audited report can also be considered, and the previous audited balance sheet need not be considered. This is a very important decision where we, the judgment is very beautiful. It basically goes not just the it determines not only the letter of law but also the spirit of law. So what is most important is the audit report on the date of the balance sheet, the balance sheet on the date of the allotment is what is important. It can be audited, it need not be audited. Yes, Ganesh sir.
Sir, what is the name of the judgment?
One second. I mean, this judgment has been picked up from the forum. 1 second.
So you are basically talking about management certified financials.
Management certified financials on the basis of on the date of the audited balance, on the date of the allotment. Yes, sir. Yes, sir.
Yes, sir. What is the judgment?
1 second. One second. I made a note of that, sir. I'll share that particular judgment, the complete judgment. I think it is Electra paper and board. 1 second.
Okay. Maybe in the chat window.
Can I say something on that?
Yes, yes, Ganesh sir.
Yeah, Electra judgment didn't say that, Uttam sir, to my understanding. Electra judgment stated that there are two components, whether valuation when it is done at a different point of time, on the date of transfer or on the date when you are trying to do the transaction, whether you require a audited financials as on that date, because that date audited financials may not be there. What judgment stated saying that the valuer need not refer to that particular audited financials when he is giving a valuation report. However, subsequently, the management must do the audit as on that date, and there should not be any material differences. So the question that came up in income tax stated that the entire report, the auditor, the valuer did not consider the audited report, and hence the valuer report does not stand merit, was actually dismissed by the honorable court. So it didn't say that you can use the previous MRL. It only stated that the valuer need not consider the audited report as of the date of valuation, and therefore he relies on the management representation. He does action, but for the transaction to complete, for the income tax to look at it, if anyone does in between a particular date or transaction, that date audit must be done later.
Okay. Good point, Ganesh sir. I will humbly beg to differ. I would not completely agree to the fact that management represented financials is completely to be ignored is not something which I will agree to.
Para number 8.
It definitely has a persuasive impact. I'll give a practical situation, sir. Let's presume that there was one party who sold his shares, one share. It's a private limited company, and one party holds one share and let's say on 13th of July, that party basically sold off the shares, in which case would it be possible for the company, the issuer company to get the audited balance sheet done? So in every case, insisting on audited balance sheet might not, but this is not yet been tested. In the future, when it will be tested, this will definitely come into question. Ganesh sir, this will definitely come into question. And in one of the paras of this particular judgment, there is one particular reference which says that the management certified financials did not deviate from the audited balance sheet which was adopted later. I'm basically drawing.
That is not an Electra judgment. I'm coming to that. What you're referring to is not the Electra judgment. It is some other judgment which is referring to a case. If I remember correctly, the transaction happened somewhere in June. And the valuer has used and the company has used the reference of March 31st transaction. But the income tax took the details as of next year March transaction. They tried to prorata and they said that the value is different from what they should calculate. And that's a different judgment. Rather, I am also searching for the judgment. I did really read that judgment.
Right.
This Electra judgment refers to the transfer, not to the allotment. And this Electra judgment actually refers to where it only refers to whether you need audited financials as on the date of valuation report. Para number 8.
Fair enough, sir. So nice of you to have referred to the judgments and also the para number. So at this point of time, we all agree that there might, irrespective of the case law, there might not be a requirement for the audited balance sheet. Point well taken, Ganesh sir. Thanks a lot. Now, just moving forward, sidestepping this audited balance sheet. My question to this forum is, when there is an allotment of shares, let's presume for a moment that audited balance sheet is also available. Let's presume for a moment that the audited balance sheet is also available, in which case, on the date of allotment, let's presume that shares have been allotted at a premium. In which case, which value should we take? Because there are two values on the same day, value per share on the same day. One is pre-allotment and one is post-allotment. So pre-money value should be considered or post-money value should be considered. I'll just leave this point for a minute to be discussed. Although the Act uses the word audited balance sheet, and we all agree that audited balance sheet is something, the need for audited can be looked with a bit of lenience. I wouldn't consider the entire lenience, with a bit of lenience, presuming just removing the audited balance sheet for a minute. My question to this forum is, should we consider the pre-money valuation or the post-money valuation? Or do you think this particular question is irrelevant?
Pre-money valuation, no?
We'll park that question, sir. Let's wait for another 30 seconds for other views, if at all there are. Cool. Cool. So now, this is what I present to you. So now let's take an example. Let's presume that there are 100 shares. The book value of those, on the date of allotment is 1000. So therefore, NAV per share is 10 rupees. Now, let's presume that 50 shares were allotted. 50 shares were allotted, and against these 50 shares, let's presume 1,000 rupees was collected, not the NAV, but 1,000 rupees was collected, and this 20 rupees is nothing but the per share value. Is nothing but the per share value. So what I'm trying to tell you is the actual transaction is 50 shares were allotted at the rate of 20 rupees per share, and 1,000 rupees was collected. In other words, 50 shares were allotted at a premium of 10 rupees. Now, in which case, considering the pre-money value, would the 10 rupees get taxed if the NAV method is adopted, is the question. The post-money value would be, the post-money value here would be 13 rupees 33 paisa, because now after the transaction, we have 150 shares, NAV is 2,000 of the company is 2,000 per share, 1,000 NAV which was already there, and 1,000 NAV which was raised by means of this particular allotment. So 2,000 divided by 150, it is 13.33. Now, which value should be adopted? It should be 10, 13.33.
I think 10.
What if if it is 10, what if in order to meet the provisions of the law, what I do is I basically get the accounts audited on this day after the allotment. I have the audited balance sheet. Will the courts consider 13.3?
No, actually, you need to see the transaction before. See, your arrival price. You can't the allotment. No. What is the value of the say? Money has not come in.
This is a question which I'll desist from answering, Chandrasekhar sir. I'll leave it to the forum to ponder upon. Cool. So now, to answer your previous question, Ganesh sir, now there are two things: 10, 20, and 13.33. Now, if I am were to look at this particular transaction, 6.33 rupees, which is actually 20 minus 13.33, is the loss which which basically the new shareholder bears, and 3.33 is the accretion to the existing shareholders value, is how I see it. This is the secret ingredient which we are discussing about. So basically what we are trying to tell is, when there is an allotment of shares, then there is not only a consideration which comes to the company, but also a consideration which flows from the existing shareholder to the new shareholders. That is also something which has to be kept in mind. And this is exactly what has been discussed in detail in the article which we had referred to. We will basically share it. So this is something which we want to ponder upon. So in the last few minutes, what we have discussed here is just the provisions of law. Unfortunately, without discussing the provisions of law, the valuation impact of that could not be well appreciated. The next discussion would be, what are the caveats, what are the things which we need to keep in mind to while doing the valuations for the purpose of angel taxation, is what we'll be discussing. Before we discuss that, if there are any questions with regards to the provisions, I'll be happy to take that for just a minute. Cool. So now we actually will be discussing some of the issues relating to the valuations under the Income Tax Act. So now the first question is, when the SSC has submitted a particular valuation, can the department dispute that valuation and come up with its own valuations? So that is the question. We have basically compiled some of the arguments for and against. The one on the left hand side contains the against arguments. That is basically an argument that the department can dispute the valuation which the SSC has submitted. The one on the right is basically the arguments that the valuations done by the SSC should not be disturbed. Now let's discuss let's spend some time on each of these arguments. So the department contends that the DCF method, discounted cash flow method, is worked on the basis of the projected figures of sales, which are inflated, resulting in enhancing the value of fair market, and therefore DCF method is not proper. So basically giving a context, the SSC had used the DCF method. The department subsequently, the SSC had used the DCF method and accordingly had arrived at particular value. Let's take an example. Let's presume that the company had had used the DCF method and arrived at a value of 20 rupees, and the company had allotted shares at a premium of 20 rupees, and therefore there was no angel tax applicable. Subsequently, the department disputed the 20 rupees valuation which the company had done. So, and one of the reasons which it gave to dispute is that for doing the DCF valuation, it had used projections, and in the projections, the sales figures were inflated. Because the sales figures has inflated, the free cash flows to the firm were also inflated. Because of it, the cost of equity, the equity value computed using DCF was also inflated. Therefore, this should not be considered, is what the department contended. At this stage, we'll not question whether this contention was accepted or not. At this stage, we'll just say that this will just it is just sufficient for us to know that this can be one of the arguments which the department can take. Then we'll also discuss what are the caveats which we can take to preempt people from using this particular, from the department using this particular argument. The second contention argument which the department has taken to dispute the valuation done by the SSC was that the valuers had not given any credence to the historical financial statements, and they arrived at the prospective financial statement, the future cash flows, purely on some biased evaluation. It was not an unbiased evaluation. This is one of the contention which the department had taken. The third contention which the department has taken is the projections made by the SSC had been incorporated in toto in the valuation report, and the valuer had not applied any of mine independently. The reason why we are discussing these arguments taken by the department is how can we protect our clients by keeping these in mind and accordingly drafting the valuation report. We'll come to drafting the valuation report in such a manner that all these arguments can be preempted. The other argument which the department had taken is the valuation report shows that the accountant, in other words, the valuer had taken the cash flow as certified by the management, which we all do. Basically, which we take the certifications from the management, but actually the department says that it has some problems if we take the certifications from the management. So it says no verifications or projections or assumptions adopted by the management was made by the valuer. We'll take up each of these arguments and we'll see how we can preempt these arguments. Appellant had failed to provide any information which formed the basis of the projections of the various years, whereas the valuation outlines the basis of valuation is past business performance forming the basis of the projections. The data used is totally unreliable without any surety or accuracy and completeness. So these are some of the arguments which the department had taken. Now, in order to defend the valuations, the SSC has basically used some of the arguments, which are selection of the method for valuation of shares was at the option of the SSC, that the AO had no right to deviate from the method selected by the SSC. DCF requires SEC to make the projection based on certain reasonable assumptions with respect to reasonableness of future cash flows, reasonableness as to industry and economic scenario, discount rate, etc. The valuer calculates the value after considering all relevant factors. While making the projection, the valuer has duly considered the planned capacity, expected demand to be generated in the future, the expected production to be done in relation to the capital and revenue expenditure, etc., to be incurred or likely to be incurred. At this point of time, what I want to highlight is the regular disclaimers which we give, the regular practice of basically accepting the valuation of projections and getting it certified by the management can be questioned by the income tax department. So what do? Do we not take projections from? Do we not take management representations from the client with regards to the projections? Should we not basically say that we do not certify the validity of the projections? The answer is no. We still continue with these disclaimers. In addition to these disclaimers, if we have to protect our client and at the same time prevent the department from disputing the valuation, our valuation, what we also need to take certain additional steps. What are those steps? To answer this question, I'll pose one question to you. When we are if we are asked to defend the valuation, let's presume the DCF valuation, what is the toughest thing which we have faced to defend our valuation? What is the toughest assumption which you have, what is the assumption which we have considered as toughest to defend? From your experiences, when it comes to DCF valuation, what assumption you found as toughest to defend? Okay, let me answer this.
Sales projections.
Sales projections. Yes, sir. What else? Sales projections. So basically, can we say that future cash flows have been toughest for us to future cash flows? It might be sales projections, it might be future expenditures, it might be working capital requirements, it can be terminal cash flows, whatever. So future based is something which we have faced difficulty in justifying. Would that be a good enough summarization of the difficulty, sir?
That is a major.
That's right. So now, what steps have we taken to defend ourselves against such questions? So now, what I am of the view is, when we are saying that for future cash flows, we depend upon the management representative, we'll continue with such a disclaimer or a disclosure. In addition to that, we will not dispense of it. Let's presume that we say that we certify or we stand by or we vouch for the future projections. Then we are stretching our neck a way too big. We are actually saying that we will vouch for the future cash flows. Now, if we give such an assumption, then no doubt the income tax department might be happy, but the people who had invested in the company on the basis of our such validation might take actions against us, saying that they took this particular decision to invest on the basis of the statement which we made that we stand by the future cash flow projections. So please do not detest from removing this particular disclaimers in your valuation report. Please continue to use this disclaimer in the valuation report. If you remove this disclaimer, then you might expose yourself to a lot of litigation from a disgruntled investor. Now, what step will you take? According to me, the step which we need to take to protect ourselves and at the same time prevent the income tax department from arguing that our valuations are baseless, because we relied on the value on the cash flows provided by the management, then in order to protect that, what we need to do is we need to have adequate working papers to establish the basis of the future cash flow projections. I will caution my dear valuers that preparing the future cash flows is not a valuer's job. It is the job of the management. Having said that, if we have to protect our valuations, if we have to defend our valuations, then we also should be in a position to defend the cash flow projections. And if we have to defend the cash flow projections, what we need to do is there has to be a basis for the projections. It cannot be taken blindly on the basis of management representations. If we want to defend our valuations, then we also need to defend the cash flow projections. If we have to defend the cash flow projections, then we need to have a basis. And this basis need not be presented in the valuation report. Let me reiterate, need not be presented in the valuation report, but it should be part of our working papers. As far as the valuation report is concerned, what I stress upon is in the valuation report, there also has to be an industry analysis. There has to be an analysis of the valuee. There has to be an economic analysis. And this economic analysis, this industry analysis, and the analysis of the valuee should tie up with the basis for which the cash flow projections have been made. If these things are not available, then it might be difficult for us to protect our valuations because we might not be able to defend the cash flow projections. Any views of the any views? We'll pause here for a minute.
Actually, if you see, you stated that we need not give in the valuation report the basis. That itself was discussed in the order also. It's not that we should shy away from giving our basis, because no valuation report is a report at all if we don't give the basis. The question is, the basis can have enough caveats, but the basis must necessarily be given. Otherwise, the valuation report does not have sanctity. And that's exactly what, if you read the order, they said that the basis is what the income tax report can question, income tax department question, but not the method. And if income tax department wants to question, they would need to see the basis. If you don't even provide the basis at all, then you are unnecessarily inviting for every report a necessary call, because otherwise how will they even evaluate it?
Perfect, sir. Perfect, sir. Yes, sir. We'll discuss this particular point. A very important point, Ganesh, sir. Any other views? I mean, apart from this particular aspect.
I think, Mr. Uttam,
Sir.
there's a basic flaw in our valuation fraternity. People just take last year's FS, just 20%, 30%, 50%, they'll make it. There's not a valuation report. They charge a very nominal amount. Basis, itemized cost, itemized, everything has to drill down to the base. Again, our answer is, as you said, these all things should be there as a part of work papers. In case if the assessing officer, any person asks, then we need to provide. Then it's I think that is better. Without the basis, completing valuation assignment, it is we are not doing justice to our profession. Any person can do.
Precisely, sir. Agreed, Chandrasekhar, sir. Okay. So, what I meant here is our valuation report need not contain the basis for valuation. That is not probably, I mean, I worded it wrong. That is not what I meant. When I said that the industry analysis, the economic analysis, the industry analysis, and the company analysis is something on which we need to put a lot of efforts. And that has to tie up with the, so if we have enough of industry analysis, enough of work done on industry analysis, company analysis, and all these things, at the same time, we also put a disclaimer saying that the cash flow projections have been relied on the basis of the management representation, I think both of them can coexist. Just because we have put a disclaimer saying that I have relied on the management representation for cash flow projections does not make my valuation report undefendable, any weaker. At the same time, the moment I put these economic analysis as a valuer, I put a lot of effort, actual effort on these parts. Me putting a disclaimer saying that I have relied on cash flow statement does not make the valuation report any weaker. That is what I intended. I'm sorry if it came out in any different manner. So what I mean to say is both a disclaimer and a analysis can coexist. It can protect not just me from litigations as a valuer, but at the same time protect my valuation report by saying that this is not completely baseless. If I were to, I would not want to put the basis. I would not want to put the basis of cash flow projections in the valuation report, because that might make the valuation report quite heavy and prone to litigation, not just from the income tax department, but for other parties also. So what I would suggest is we keep the basis for cash flow projections in our working papers. At the same time, we give a better economic analysis, and all the narratives is what we develop. As the guru of valuation says, Ashwat Damodaran says, it is not just the numbers, but the narrative which matters when it comes to valuations. Okay, so the next part is basically
one point just to say, as
Yes,
I
sir.
said, but in that judgment they said, most of the
Sir.
cases will also say, we are not independently verified the projections, we relied on the management certified financial projections will say. But can we add one word saying that without watching, in our opinion, based on the past history, it is a reasonable. Can we add that word, or will it have any? Because it can be one situation last 3 years, 20% projection. They also consider 20%. There can be situation without any base startup company, they project huge numbers. So such second situation we can totally disclaim because there is no basis, we cannot watch. In the first situation, reasonably it is okay. So can we add the word in the part to protect the client, saying that reasonably, in our opinion, risk seems to be achievable, seems to be reasonable, or are you taking more risk?
Sir, I'll be a bit careful there to say that I would say that the future projections are achievable or reasonable. I would not want to use those words. I would rather say that on the basis of the past, if the future projections are akin or in line with the historical projections, then I would say that it is as part of the historical projections. But if they are diverse, then I would basically allow my analysis, the narratives which I built to establish that fact.
No, okay. What I'm just trying to what I want to say is income tax. They said valuer is not done anything. Just something they were given Excel number is used that difference from the where there is a projection. I think we are only looking for our production, but ultimately there is a purpose. No, client has to convince the department, and also when we give the report, it is acceptable. My point is, if a company has done consistently 20% growth for last 10 years, if the same 20% or 25% they projected, one can give a little is subject to the economic conditions. This seems to be reasonable. Other situation is startup company without any base they are done. So what I want to say is, our disclaimers has to be not standard all, depends upon the projections with the past. Can we change it?
Definitely, sir. And if you are a startup company, if a company which does not have comparable history, I would use the word comparable history. I would not call any history to be a history. I would call it as a comparable history. The reason why I'm calling it as a comparable history is I mean, nowadays we have very loose usage of this word startup. Let's presume that there is a company which has been in the textile industry, textile industry, and let's presume that it has got a lot of real estate with it. and due to various due to the, let's presume that due to the business environment in textile, the company is making losses, whereas the real estate which it holds is capable of generating a lot of future revenues. In which case, let's presume that the company which has been in existence for many years with consistent losses wants to basically get into real estate and make use of the real estate which it has. Does it mean that it still has to project the future with losses? The answer is in negative. So what I mean to say here is that the fact that there can be an existing company with history which can also which can also be a startup, but unfortunately we are using startup, the word startup with a very small meaning, because of which the existing companies have been put a lot of scrutiny. So therefore what I mean to say is, whenever there is a history, and if this history is comparable to the future, then as Chandrasekhar sir, as you rightly pointed out, we can definitely put a disclosure saying that the future cash flows is as per the projections. I would go one step forward. I would say that in such cases, the chances of dispute might be very less, because if the future has also been projected akin to the past, then the value derived from the future cash flows might be similar to a cost method if it is applied. So the struggle is when the future is quite divergent from the past. In such cases, we have to apply more vigor, more strength. So that is the reason, as Chandrasekhar sir, you rightly pointed out, a lot of people, especially when it comes to startups, as valuers, what we normally consider is, for existing companies which has history, and for existing company which has history, if we have to project the future, we feel jittery. But for companies which do not have history, we are very adventurous, and we can basically put out any future numbers, because it does not have history. We feel that we can adopt any future cash flows. If let's adopt any future cash flows, but let's also have a narrative which can establish this adventure. That is when we'll be able to defend our valuations better. When it comes to existing companies, let us put some efforts to see to it that the future cash flows can tie up with the past. If they are not genuinely not tying up with the past, let's put a reason why it is not tying up with the past. What I mean to tell my fellow valuers here is, when we are doing the valuation for startups, in our zeal to be adventurous, in our zeal to basically please our clients, let's we might accept any future cash flows, and since we are accepting any future cash flows, let us not detest from putting a good justification for the cash flows. And if we put a good justification, then our audit efforts will then our valuation efforts will go up. And let us please consider these valuation efforts while quoting prices, because we have seen a lot of valuers, definitely not from this group, but from elsewhere, who have done valuation assignments in a very short period of time, with quoting a very small fee, by adopting any valuations, any cash flow projections which the client provides. So let us not do that. Let us basically, if we do that, then the entire valuation exercise will become a farce, and we will not be able to, as collectively as valuers, will not be able to defend ourselves in the future. So this is my urge. This is my urge. So there are some to sum up, to end this particular session. The last para is the last para which we have put across is something which summarizes the entire discussion. I'll read it for the benefit of everyone, which says, the primary onus to prove the correctness of the valuation report is on the assessee, as he has special knowledge and he is privy to the facts of the company, and only he has opted for this method. Hence, he has to satisfy about the correctness of the projections, discount factor, and terminal value with the help of empirical data or industry norm, if any, and or scientific data, scientific method, scientific study, and applicable guidelines regarding DCF method of valuation. If our client has to protect himself against any disputes by the department, then we as valuers should be in a position to help our clients defend by ensuring that our valuation reports contains projections which are based on empirical data, industrial norms, scientific data, scientific method, and scientific study, which exactly is built up in the narrative which we provide in the various analysis which we provide as part of the valuation report. So with these words, I would want to end this particular talk on valuation impacts under Income Tax Act. I again thank Bangalore Valuers Association and the audience for giving me a patient hearing. We can leave this floor open for 4 more minutes for any questions, for any opinion on today's topic. Cool. I would also want, yes.
Yeah, Uttam sir, I missed the last discussion in pieces. Sorry if I'm just repeating it again. Regarding the start of valuations, yes, they are giving very adventurous projections, and we have to value on that. I was listening to Aman Gupta of Boat Company. He was saying that his first year sales was 10 CR, second year was 30 CR, and third year was 100 CR.
Correct, sir.
And fourth year was 2000 CR.
Sorry.
Now, with this data, suppose other company, our startup client, gives these kind of projections, how do we handle it? Because this is very adventurous. 100 to 2000 CR, it's a mind-boggling figure.
Correct, sir. So here, let's presume that the client provides us a growth rate of, from the numbers which you gave, I'm looking at a growth rate of 333% kind of stuff. 10 to 30, 30 to 100, 100 to 2000, roughly about 300% growth rates kind of stuff. If my client also wants to give such kind of growth projections,
Correct.
then the I would want to, and if I want to defend this, if I want to accept and defend this, then I would sit with my client to say why my company is similar to Aman Gupta's boat. I will spend some efforts there. I'll spend some efforts there and just say that, and just not say that just because Aman Gupta says 300% growth, I would not accept it just like that. I will want to say why I am akin to Aman Gupta, to both company, or for that matter, any company. I mean, I also understand that two companies are not comparable, but we can pull out the ingredients of comparability. There might not be apple to apple comparison. One might be a green apple, but the other one might be a Kashmir apple. We need to pull out the ingredients of comparability and accordingly build that narrative. That's what I urge my valuer friends to do. And this should come out. The 300%, 800% workings might be in the working papers. But when it comes to this narrative, this should basically come in the valuation report. The narrative should come in the valuation report.
Okay.
And before taking any opinion, one more important fact which I wanted to highlight is this. So in many disputes, the valuation of the valuer has been summoned by the courts to defend his valuation, and there will be times where we as valuers will also be asked, summoned, not just by the income tax department, by other authorities also, to defend our valuations. This is something which we will have to accept and not shudder. We need not be apprehensive about such summoning. Let's orient our mindsets that every of our valuations might be summoned. At this point of time,
Sir,
one point. Let me just complete this. So, what we need to orient ourselves is that we will be summoned at the same time. When we are summoned, let's presume that we are summoned by any authority, then our efforts to defend our valuations is completely different from our valuation. We should understand that the efforts which goes towards summoning is to defending is completely different from the valuation engagement. We need to, just because I had given a valuation report 1 month, 1 year, 10 years earlier, does not mean that I am required to defend my valuation report till time immemorial. These are two different engagements. And that is something which we need to put in our engagement letters, saying that in the future, if at all I am required to defend my valuations, that will be a different engagement, and the client should be ready to provide me reimbursements at the agreed rate in the future. I am not sure whether I will be able to recover anything from the client, but at least I will have a basis for recovery. If I do not include this in my engagement letter, then I will be making an open-ended statement which I'm not comfortable with. The point which I want to make is summoning is something which we should not be apprehensive about. At the same time, let's consider that as a complete engagement, and we ought to recover the cost, the efforts which goes towards defending our valuation from our clients or from any other party. Yes, someone had a point here. Sorry.
yes, sir. Sir, it's still not clear to me in a plain thing. I have given the example of Aman Gupta as a base. I'm not, suppose there is my client is company A, which is not at all related to a boat company. It may be in a different sector working, but they also give me this kind of projections.
Sir.
Now, I whatever narrative I give or something, but after 2 years, the actual result is the 2 years thing was coming into losses. I mean, this is the actual result, but the projections was 10, 30, 100, 2000 and 4000, right? But how I'm going to defend this thing?
Sir, one thing is for sure. This exact point has been disputed by the department many a times, saying that many a times in the department we have also been, in the various assessments, as an income tax practitioner, we have also been asked to do a revaluation on the basis of where we replace the projected numbers with the actual numbers which is available. We should not get into that exercise, sir, because let us be clear on one point, that the benefit of hindsight which is available today was not available on the date on which this particular valuation was done. That particular argument has been accepted by the income tax department, by various courts, saying that the subsequent year's figures cannot be replaced for the actual figures, cannot be replaced for the projected figures. That is something which is acceptable. Having said that, if on the date on which I accepted the future cash flows to be 300%, 500%, there has to be some basis, sir. It cannot be that 300%, 500% is out of basis. There has to be some basis. I can give you some pointers on what basis it might be. Let's presume that I am preparing these posters. I am in the business of these posters, and I am projecting I'm projecting a growth of 300%. Then I should basically say that this coaster industry or some uniqueness in this coaster makes me sell it at, makes me think that my product will sell it at 300% compared to regular coaster, which is basically growing at 10%. Coaster industry, which is growing at 10%. There has to be some uniqueness which makes me, and that uniqueness is what I'll have to establish in my in my valuation report, Saurabh sir. Does that answer your question? Does it make? That's where the challenge is. That's where the challenge is. If I'm accepting 300%, 500%, or a disproportionate number as a growth figure, then there has to be some basis for that. Some basis. It cannot be kept naked. If I have kept naked, then I'm exposing myself to a lot of scrutiny, sir.
Thank you so much, sir. Now it's very clear. Thank
Awesome.
you.
Thank you. Thank you. So I have overshot my time. I'm really sorry for that. We'll quickly wrap it up. Any other questions? Opinions? Thanks a lot. So I'll be sharing with the management of BVA. I'll be sharing this particular presentation and also the articles which talk about tax implication on existing and new shareholders in the case of primary transactions. So we'll be sharing those articles and we can discuss that offline. It would be my pleasure because every time I discuss, I get a lot of new insights. Thanks a lot. Thanks a lot, everyone.
1 minute, dear members. It is our pleasure to have our own member, the CA Uttam Padival, as the speaker for this day. It has evinced a lot of interest among our members to know how we should go for the valuation under the Income Tax Act, its importance, its need, then and various provisions, various rules under this valuation. You have explained in detail the book value method, the cost method, and the combination of adjusted book value method, which is a unique concept, then valuation under the one valuation required on transfer of transfer from the viewpoint of transfer and receipt of quoted shares of securities and unquoted shares of securities valuation. You also revealed that say valuation can be done anyone, even with the company employees also, except in the case of unquoted shares and valuation requirements on allotment to the issuer company, then various decided cases, then arguments, then disclaimers and all, and analysis which we had to make while giving our valuation report, etc. And it has enlightened all the members. I thank you very much. And also you have offered your help to discuss the matters which could not be discussed in this forum due to paucity of time in private. So we are very much grateful to you for your generous offer to discuss them in private, and also your offer of sharing your articles, etc., with all the members. Thank you a lot, and we expect some more such enlightening sessions from you. You have got a very good knowledge in valuation, particularly on income tax valuation. Thank you, and thank you all participants for your active participation and joining this wonderful session. Good day to you all, and we will share this memo to. We will send it to you by courier, and in a couple of days you will receive it. Until the meantime, I say we are just displaying you the memento, which will be courier to you. Thank you.
Thank you so much, Uttam. Thank you so much.
Nila, you can now stop the recording.